Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase on August 12, 2026. This is Raymond Cheng here. Today, I will highlight the recent downtrend of the yen against the US dollar and our outlook on the yen carry trade and Japan equities. Since the recent joint US-Japan intervention in the beginning of the month, the US dollar has ticked up from 157 to above 159 against the Japanese yen so far this week, unwinding almost half of the yen's gains. First, let me start off by explaining why I call the latest intervention a joint intervention by the US and Japan, and how the recent intervention differed from previous intervention attempts. Traditionally, Japan had to intervene by selling its U.S. Treasury holdings to support the yen, which would cause U.S. Treasury bond prices to fall and yields to rise. In order not to negatively affect U.S. bond yields, this time the coordinated intervention allowed Japan to borrow U.S. dollars using the Fed's Foreign and International Monetary Authority's repurchase facility, so that there was no pressure imposed to the U.S. government bond market, while Japan could support its currency. Now, as we assess this intervention, we think this could strengthen credibility of official action and constrain outside speculative moves. But we are concerned that the still wide U.S.-Japan interest rate differential will likely remain supportive of the U.S. dollar against the yen. The Bank of Japan's July summary of opinions show some policymakers there were in favor of faster policy normalization, given underlying inflation approaches 2%. We believe Japanese authorities are focused on curbing disorderly moves as opposed to reversing the underlying trend. So our base case assumes one additional BOJ rate hike before end of the year. From the currency standpoint, if the move above 159 is sustained, this could open a retest of 160. We expect the currency pair to trade in a relatively tight range, given intervention concerns will likely cap upside. As for the implications to Japan equities, we are mindful that the yen volatility could add some headwind there, as over half of MSCI Japan revenues are derived from overseas markets and hence affected by currency fluctuations. That said, consensus earnings growth of Japan corporates for this year has been revised notably upwards, benefiting from the ongoing corporate governance reforms and a reflating economy. Therefore, we maintain core allocations to Japan equities. Now, within the Japan equity asset class, I highlight Japan banks as our opportunistic idea. As the BOJ normalizes its policy stance, this should provide upside potential for the net interest margins of the Japanese banks. Japan's reflation cycle will also help to support nominal loan demand, corporate capex, and wealth activities. Recent policy measures such as policy to facilitate large-scale project financing, such as data centers and M&A, should give the megabanks larger flexibility to underwrite larger transactions and room to accelerate corporate loan growth. In addition, plans to encourage Japan's government pension investment funds to reallocate more back to the domestic capital markets should raise the bank's growth outlook and support the yen as well. So, in summary, we believe the recent currency intervention will only limit the speed and magnitude of the yen downside without changing the fundamental perspective that the yen could stay weak in light of the interest rate differential between the US and Japan, unless the BOJ continues to raise interest rates from here. Given the expected yen volatility, we recommend core allocations to Japan equities and selectively focus on domestically oriented industries such as Japan banks, which could benefit from further interest rate hikes and policy-driven loan growth. That's all I have for today. Thank you for listening and have a wonderful day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, Visit Market Views on the go on our website or click the link in the description.